Welcome to the Compass Wealth Conversation Podcast. Today we will discuss unique funding options related to providing care and support for our loved ones as they age. Join us as we explore the challenges and triumphs of long-term care, hear from the experts in the field, and share practical advice for navigating the complex world of senior care. Whether you're a caregiver, a family member, or someone seeking information on long-term care options, this episode is for you. Let's dive in and explore the important topic of long-term care. Right now, I'd like to welcome Jeremy Veryser, a Regional Account Director of OneAmerica. Jeremy, thanks for joining us today.
Hey, thanks, Brendon. Good to see you, my friend.
Good to see you, man. We've met a few times at different places. We get to talk about different cases and people that we get to work with and help with long-term care and their experiences. So what brought you to OneAmerica?
Yeah, it's funny. We're all products of our environment, I suppose, in some way or another. And for me, it was really no different. As a young child, my folks, they moved from Michigan to Colorado a couple years before I was born. And basically, my whole extended family's out in Michigan. And probably when I was about 9 or 10, I believe, we had an event where my dad's mother, my grandmother on that side, started going downhill. Spent through what assets she had. My grandfather had already passed away. And my dad's sister, who was married, they ran their own business, Brendon. They had the money, but not the time to help my grandma out by putting her, unfortunately, in a home, private pay. So they cut a deal with my folks and said, we'll move her to Colorado if you and the kids can visit her routinely. So from a young age, I was definitely scared of nursing homes. I mean, she had a semi-private room, which was just a sheet in between her and the other gal. We could hear everything. We could smell everything. And I just remember not wanting to step in that place, and that I didn't want anybody I knew to ever have to go back to one of those. And keep in mind, this is a private pay, kind of top-notch.
Semi-private.
Yeah, semi-private. But still, it wasn't like she became destitute and fell onto Medicaid. So fast forward years later, I knew I wanted to be, when I went to college, I wanted to be in the finance industry. So I started in retail banking and then kind of worked my way into the wholesaling of financial instruments, retirement products, and was fortunate enough to find OneAmerica, and that was 17 years ago.
Wow. So you've been there 17 years. So it's almost half the time, because about 30 years ago, they came up with a concept of asset-based long-term care about 3 decades ago, pretty much.
Yeah.
1984, something like that. Am I wrong?
First it was we've been in the business since 89, but we didn't get the first piece of legislation for the tax advantages until the HIPAA of 96. So you're right on the money.
Oh, wow. I mean, and those advantages for the HIPAA, could you give us a little bit more detail about that?
Yeah. So I think, when people hear the term long-term care, we have visions because it's been ingrained in us, nursing homes and, the inability to take care of oneself. And while it certainly can be that, at one time there was over 100 carriers offering kind of grandma's old school nursing home long-term care policy. Some of those policies were only available to go into a facility. Well, as we know, Brendon, you and I've talked about it to great lengths. People want to stay in their home for as long as they can, right?
Yeah, especially after COVID.
Right. COVID. Totally. I mean, that only made it more of a pressing desire, right? We have these visions of people, in bubbles having to touch their loved ones, right? If they could even see them. So the HIPAA legislation, what it did is, and this was pretty groundbreaking at the time, but it allowed certain life insurance policies that complied with a small portion of the HIPAA. It's a big piece of legislation. It allowed folks to access, while they were alive, accelerate life insurance tax-free, including that leverage that you get on the death benefit for any care. And if a carrier or company is going to extend the benefits, even after the death benefit is gone, that too is tax-free.
That's pretty interesting. I mean, it does change the whole notion of a traditional policy to this asset-based type of policy that we do now use today as part of it, in compliance with traditional long-term care if people still have it. I mean, you said there was 100 companies at one point. How many companies are still left?
Yeah, I mean, I think, if you really wanted to split hairs, it's like, I don't know, 7 or 8. But some of those are only available in captive environments. So really, in the open market, which you as an advisor obviously have access to any carrier in that market, there's really 3 main carriers left.
Right. So when I look at long-term care and indifference, depending on the client sitting across the table from me or the active customer looking for it, I look at, do they, will they qualify for traditional long-term care? It could be a crapshoot in qualifying that. In the asset-based world, you have a little bit more flexibility, right? Would you say?
Yeah, certainly. Because if you think about it, the majority of Americans today are self-funding by default, right? We don't own a long-term care insurance policy for whatever reason, whether that was health or I just didn't like something about it. I don't think I'm going to need it, whatever it may be. With the asset-based, you're either repositioning an idle portion of the nest egg that you would have to use anyways, default self-funding. But you're leveraging that while maintaining control of that still on your balance sheet, but having access to up to lifetime tax-free LTC benefits and a death benefit if you don't need it. So to answer your question, because I'm kind of using my own money in the first place, then that opens the door for the companies that offer it to be able to take on more health conditions and issues that maybe wouldn't have been available under the old school type.
So you said something interesting, leveraging. They're leveraging dollars to either one to pay for long-term care using their dollars for themselves and for their spouse, right? Because you can get a joint policy and leverage one person's dollars for 2 people.
Yeah, great point. And you can even do that with what we call qualified funds. So 401ks, 403bs, IRAs, which are obviously individually owned. We can repurpose those or redeploy those and then cover, say, a husband and wife using the wife's old IRA or a portion of that as an example.
Oh, and you could even would you use inherited IRAs? Could you use inherited passed down from because of the new rules of the Secure Act of 2019?
Yeah, that's something we continue to see more of as, unfortunately, we're in a scenario where, we're having the very end of the baby boomer generation approaching that age where some begin to pass. And much of their wealth is in that sort of qualified realm. And so if that passes, as you're alluding to, Brendon, to a non-spouse, so kids, grandkids, niece, nephew, now they have to have that out in 10 years. Well, we're able to comply with that while also leveraging these dollars either for LTC and, as I mentioned, having a benefit should they not get care as well.
And that could be a benefit because they could either do it themselves over 10 years or they can actually do a direct rollover to the company and the company could do it for them, correct?
It's all turnkey, and it doesn't have to be an all or nothing, right? You see this all the time in your role. I mean, maybe my uncle didn't have kids. I was his favorite nephew. I inherit $400,000 from him when he passes. Doesn't mean I got to do all 400. I mean, I have to have all 400 out in 10 years, right? But maybe we just use 200, let the company kick that over 10 years, which satisfies my Uncle Sam requirement. And then they can work with you on, a different method for some other purpose like income over the remaining 10 years on that.
Yeah, I mean, to me, it's a simple idea, right? It doesn't have to be all of it, like you said. It can be done over 10 years, and then it's finished. So the days of traditional long-term care where you paid it up until you used it, right? Now, with some of these asset-based products, you can do one pay it all at once if you want to, right? 5 pay, 10 pay, and some companies do 20 pay, right? So if you're a business owner looking for some type of tax write-off, could you use that as a strategy over a 10 or 20-year period?
Absolutely, yeah. So these hybrid or asset-based LTC policies, which are combining either the foundation of life insurance or annuity, We didn't talk about the annuity, but that legislation came in 2006 through the Pension Protection Act. But either way, you can use a portion of the premium that you're either funding over time, which you would want to do with the business, and depending on the business structure, and of course they partner closely with you on figuring this out, but there's a portion of that premium that could be not only deductible to business, but potentially tax-free to the person it's benefiting.
And that's such an interesting concept, because how many business owners today know that they can go and purchase a long-term care policy for them or their employees or their spouse and use tax deductions through the business to help get that done?
Yeah. And I mean, even on an individual basis, you can use me as an example. So I'm in my mid 40s, I'm 45. My wife and I have a 20 pay, which you mentioned. We can even extend that out to a continuous pay. And the advantage is this, by the way, at least here at OneAmerica, really in the industry, that's the most popular way for people to fund it, right? Because there's plenty of people that, hey, I don't have 150 grand that I can reposition at this point in my life, but my wife and I can afford 3,000 each year or 200 a month. So on an individual basis, you can also do the same thing. And a portion of that premium, the IRS looks at no different than a traditional LTC premium. And so my wife and I use our health savings account to fund a portion of that premium. So we're using pre-tax dollars to fund a lifetime tax-free LTC benefit. Pretty neat.
I think the HSA is one of the most underutilized investment vehicles that you could have.
Me too. And that's why we use it, right?
Right, exactly. And then you mentioned qualify. You used the word annuity. So you can use non-qualified annuities and IRA annuities, depending on if they're out of surrender. You can, roll over a portion. But the non-qualified piece, OneAmerica does have a history of using non-qualified annuities to purchase some type of long-term care, right? These asset-based products.
Right. So I mentioned the 1996 HIPAA, which allowed for the life insurance component, certain life policies tax-free. The government, with no lobbying on our end, right? The government just said, hey, we see this massive wave of the baby boomer generation approaching the age in which it would be really ideal for them to create a plan, as opposed to becoming destitute, spending down assets, and falling onto the welfare program known as Medicaid. What can we do to encourage private planning? So they did the HIPAA, giving up some tax to encourage a private plan. And then in 2006, the Pension Protection Act amended that HIPAA to say not only will we allow certain life insurance policies, but certain non-qualified annuities can be used tax-free, including all that gain I built in that contract throughout the years for any care, including in the home, as long as it meets that guideline.
So you can use the gain and not be taxed on the gain in the non-qualified annuity if you roll it over?
As long as it's used for care. If it's not used for care, it's going to act like the annuity already acts, taxable to the heirs.
That makes sense. I mean, it's a nugget that not a lot of people know. And unless you're having those conversations, or the advisor or myself across the table, most consumers don't really know that part of it.
Heck, some CPAs don't know it.
Some people bought non-qualified annuities, back, it's 2024, back in 2012, and haven't touched it, or bought it back in 2005, or just keep using a fixed annuity and it just keeps moving over and regurgitating into the 5% or 3%, whatever it's earning, and it's just sitting there as a savings vehicle because they've put a bucket away for some kind of care, but they're not using it for any type of care or have a policy designed for their actual care.
Yeah, I mean, non-qualified annuities are pretty interesting because unlike, say, an IRA annuity that's going to have that required, Uncle Sam's going to come knocking, saying you're at the age, you got to start pulling from it, whether you like it or not, pay your tax. With the non-qualified, as you know, Brendon, they don't require that. You can hold that till I live to 110 and never touch it. Then that gets taxed to my heirs. So what we've seen in the industry is a lot of folks with these non-qualified annuities do exactly what you mentioned. It just kind of defers that growth. I'm not forced to take out of it. It becomes a rainy day, kind of just in case fund. And as I age, the most likely rainy day or just in case need is healthcare, extended health.
So the other thing that I particularly like about OneAmerica, just because I do use the product, so that's why we have you on, is the lifetime benefit rider for life, right? Care for life. God forbid you have Alzheimer's, dementia, Parkinson's nowadays. The average stay jumps from 3.7 years for men to about 8.5 years. So if we're looking at a top of the line nursing home facility in PA, we're at 150 grand a year. Now, 150 grand times 8, we're over $1 million. Who has $1 million set aside? And that's just for one person. So if it runs in both of your families, and you could purchase something like this, and it would pay for the lifetime benefit, I think that would be helpful. Especially to leverage those dollars, like you said earlier.
It's one of those things where, as we saw a mass exodus from the traditional long-term care insurance policy, we didn't for decades see folks in this space. It was kind of before its time. Now we've seen a mass entrance. But yeah, the lifetime benefit is unique to us and for exactly that purpose. I mean, again, I own it, right? Myself, these catastrophic illnesses like the dementias, Alzheimer's, for example, these are the events that unfortunately, as a society, we live longer. We've cracked the code. We have all these, medications to keep the body alive, but we haven't cracked the code on the cognitive impairments. And those are what tend to really devastate not just one's financial position, but the family.
Especially if the child or like your son or daughter have to take care of you on a given basis, right? I mean, your experience with your grandmother is the same as mine. My nana, who was my mom's mom, she was in the ward at Fitzgerald Mercy, which is a hospital right around here. And like the day of my wedding, I went to visit her early in the morning, and she had maybe 5 minutes. Like she understood me for 5 minutes, and then She went right back to, not knowing who I was. But she was in a room kind of like your grandmother was, and it wasn't like they didn't have the money to pay for her. So when I look at that, when I have these conversations with people, those are kind of questions. Do you have a family history of, dementia, Alzheimer's, Parkinson's, and kind of look around, what it is and what it's based around.
Yeah, I mean, you think about it, like there's a lot of folks out there, some of your clients, who if they only need care for a year or two, they could self-fund it without really putting too much of a burden. But we don't have a crystal ball. This would be easy if I knew I was only going to need 6 months, I could prepare for it. So to hedge against what is really the elephant in many people's financial plan, right? With the benefit I can exhaust, should I have a catastrophic event, but also maintain a balance, a cash balance, that if I need to access it, I can, and a leverage, benefit for my heirs should I not need it. For a lot of Americans, that just makes a ton of sense.
It makes a ton of sense. Because while we mentioned that your daughter or son or whoever it may be, a family member might want to take care of you, they can't do it 24/7 because one, they have to work, right? They have to still provide income for their families. They're going to need someone to come in and take care of you, whether you're at home, whether it's, transporting you to different doctor's appointments. It's the kind of care that they need, so they can use these OneAmerica policies to help pay for that home care. And that starts the cost of care right there in your home, day one, right?
Which is where the vast majority of the claims are. It's interesting you bring that up, buddy, because we've seen a dynamic really change in the American public's desire to want to plan for this. Kind of along the lines of what you were saying is, you think about the baby boomer generation in particular. The youngest this year is 60, the oldest is 78. Many are at the age where their parents are now in their 80s, maybe early 90s. So between, if I'm married, mom, dad, mother-in-law, father-in-law, there's a really good chance I've had that experience. And there's also a good chance they didn't have a plan, but to deal with it when it happened. Right? And so the kids became the plan. And so what we're seeing is a lot of people have this desire now because they've lived the pain. They felt the pain. They became the plan. And now they're saying, I don't want to do that to my kids. So it's more uncommon these days that people's desires for their oldest daughter to quit working and take care of them. They want them to supervise the care, but not be the one providing it. They don't want them to put their lives on hold.
I would say 70% of my conversations come from somebody going through the experience or recently have gone through the experience of taking care of a loved one or a family member with, the nursing home situation. So I think that, that always strikes a nerve with them. I don't want to end up in that position. I don't want to use all my money. There's nothing left for the inheritance. And, not that that's the important part of it, but it's more of, I can't believe if we would have done this, these things could have been a little bit more detailed or controlled, because you're not trying to pay for everything. You're trying to pay for a portion of the care, right? You're trying to make sure that it's covered so that you have enough time to help the people you're trying to help.
And we very rarely see that. The Cadillac plan these days, where somebody's trying to match exactly what it'll cost today and project it out with the 3 to 5%. I mean, that's not going to come cheap, right? But let's remember where we are as a society right now, and that is, I'm going to turn to my hard-earned nest egg, and I'm just going to siphon off dollar for dollar and pay tax on any gain. So to your point, we're just trying to help supplement and really put a wall against the rest of the assets. So if I have a healthy spouse, for example, my wife can continue to live the life that we had planned, and I'm not changing her lifestyle.
Right. And that's what you look at every day. And that's usually what I say when somebody purchases some type of long-term care. It's like a feather in your portfolio. It's the cap on top, because most people haven't looked at it or haven't thought about it at that point, right? I mean, Jeremy, we've gone through a lot of information today, and a lot of, some people are going to be like, oh my God, I don't even know what we just heard. But if we could recap some of the importances of what a OneAmerica product does, what would be your top 3 takeaways of some of the stuff we covered today?
So first and foremost, these solutions exist because of 2 pieces of IRS tax legislation a lot of folks don't know about. The second is that there are methods in today's marketplace that allow you to use what you'd already be using, leverage it up into an unlimited tax-free plan that covers in-home care among the other types. Yet, if I don't need it, it's still my money, and there's still a benefit to my heirs. So I think that's, as a summary, short and sweet, that's really it. The third, maybe that there's a variety of ways to fund this, whether it's, as you mentioned, the single premium, or like my wife and I have, we're going to pay over time as we are, and those premiums can never go up. They are fixed and contractually guaranteed. So I think if your audience could walk away with just a concise little nugget there, those are the 3 things that hopefully people look at and go, I didn't know that to be true. That sounds too good to be true. Brendon, how's this work?
Yeah, you would love to have those conversations all the time. I just want more people to start having the conversations. I mean, that's why I know you're passionate about it. I believe that I'm passionate about it when we talk about it with different clients and just people every day out in the world. You just have those conversations because you want to make sure that their family is just protected. That's really the end game, is to make sure that the legacy is there for those families.
Right. I mean, the devastation to the family is the number one reason that we see, especially us guys, move forward on this, is that it's the same reason I might buy a term life policy. Is the likelihood that I'm going to die during that term high? Not at all. But I can't stand what would happen to my family if they lose my ability to help protect them and generate, the mortgage payment or whatever. So it's really about that, because guys will say things, this, Brendon. I'll say something to you. If I haven't lived that pain yet, I'll say, I don't need care. I'll just go out in the woods with a shotgun because I haven't lived it. I haven't experienced it.
And who's going to pull that trigger?
Right.
I haven't found one person say, oh yeah, I will.
Yeah.
They don't. I just kind of chuckle it off anymore because it's a standard line.
We're stubborn. Us men, we're stubborn. We like the ostrich approach. We like to put our head in the sand and not deal with reality.
I don't know that my wife would say that about me.
Oh, yeah. Uh-huh.
Jeremy, I really appreciate your time today. The knowledge was great. I mean, it was easy conversation. So everyone out there, please, if you want to have a conversation with us today, we're having these conversations, these important conversations about long-term care and the planning that can help save your portfolio and your legacy. Thank you very much. Talk to you soon.
Thank you for listening to the Compass Wealth Conversations podcast. Click the follow button to be notified when new episodes become available. Visit our website at www.mycfsi.com. That's www.mycfsi.com. Or give us a call at 610-449-9900. And don't forget to click the follow button to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Compass Financial Solutions Incorporated. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Please note that the information provided in this podcast is for general informational purposes only. All opinions expressed by the hosts and guests are solely their own opinions and do not reflect the opinions of any institutions or entities they may be affiliated with. This podcast should not be considered as financial or tax advice. We strongly recommend consulting with a professional financial advisor or tax professional to get advice tailored to your specific situation before making any financial decisions.